Much has been said about China's debt position. It has been much overstated. The debt is consolidated in state-owned enterprises, local governments, and private companies. The central government has enough foreign cash reserves, land assets, and state-owned enterprises, or SOEs, to pay off the debt in full. The issue is not if China will have a crisis, rather, will it experience an economic slowdown due to poor allocation of resources. China has followed an unbalanced growth policy since the reforms implemented by Deng, meaning coastal regions will be prioritized over interior regions. China has been tiptoeing between making the coast economically vibrant and keeping the interior regions passive through investment. This investment is provided by state-owned commercial banks. The capital used in these investments are the savings of the Chinese people. Capital is controlled tightly, with the government owning most of the investment vehicles available. Some of those savings are spent/loaned to local governments. This causes inefficiencies and misallocation due to local Chinese officials' use of state-owned commercial banks to fund policy. This fiscal policy is at the heart of the Chinese financial dilemma. These state-owned commercial banks, or SOCBs, provide leverage for underperforming SOEs, infrastructure projects, and other projects directed at economic growth. Economic growth is the solution to surging levels of debt. However, China has experienced a slowdown in combination with surging debt levels. The question is whether China will allow for SOEs to fail or to perform more efficiently, increase productivity through intermigration to megacities such as Beijing and Shanghai, allow foreign companies to operate freely in China, and increase interconsumption at a time when China is overproducing goods. These are monumental tasks that may or may not be corrected. During the recent third plenum, Chinese leaders discussed these issues and are fully aware of them, announcing migration to smaller cities will be liberalized, cracking down on risky parts of shadow banking, and running experiments in local governments to find incentives that work with stable growth and state control. Unfortunately, these experiments have only taken place in richer regions, with poorer regions still continuing the fiscal misallocation today. Funding infrastructure projects to remote areas instead of promoting migration to inner cities, building ghost cities, and providing subsidies to SOEs. China has a strict migration policy. Inner migration is restricted with hukou, or migration rights to state-sanctioned workers. These rights allow for ownership of land and social services. This creates a problem, not allowing for megacities to grow to an organic size and decreasing economies of scale. Due to these illegal residents being barred from social services, they save high proportions of their income in comparison to an already high savings rate for Chinese. Freeing up intermigration is another avenue of growth for the economy. This combination of high savings, overproduction of consumer goods, and state control over capital leads to inefficiencies in capital allocation. The income produced from these investments fund interest rates in the average Chinaman's savings account, CD equivalents, and other financial products. If these loans get out of hand, confidence in the banking system will fall. The debt will not be serviced. The central government will be pained to sell profitable assets such as land, foreign debt holdings, SOEs, or even adding more debt to the central government's balance sheet. China is walking a fine line between debt and economic growth, with debt funding growth and growth lessening the burden of debt.